calculate the balance of trade. Balance of trade is the difference between the export feasible goods minus the import feasible goods. That is, feasible goods that are being exported, you subtract the amount from feasible goods that are being imported. And from this question, and they said the table below shows an extract from balance of payment from a country A. So they said we should use the table to answer question that follows, and the table is below. So if you check, the first thing you have on this table is the merchandise, and in front they said is the feasible goods. The second thing is the shipping, other transport and travel like that. You have investment income, you have other service and all required transferred and the likes. So when you're talking about balance of trade, I said is the difference between the export feasible goods and the import feasible goods. Exactly. So the receipt here does not stand for receipt. It stands for the money being received from abroad. That is money you received. For you to receive money, it means you have export something. So this stands for the export money, and the payment here signify the money you pay. So for you to pay for something means you have imported something. And if you check this table here, the only feasible goods you can see here is the number one here, which is feasible trade. Are you following me? That would be the only thing for the balance of trade. So your solution now, for you to do your balance, let's say A, for you to do your balance of trade, which equals to the export feasible goods minus import feasible goods. So that means you will be subtracting this 52, which is the money for the export. You have 52,000 minus the money you collect from the import, which is 4,000. Which is 4,000. So you have 52,000 minus 4,000. So your answer is 48,000, and in dollar that will be your balance of trade. And the second one, which is the balance of current account. If you're talking about current accounts, you're talking about the export feasible goods, import feasible goods. You're talking about any investment within the country, any transaction within the country, or any business that was run within the country. Everything is under current account. As long as the transaction and everything, the goods and services, everything happens with the country, you put it under anything that deals with goods and services and it is run in the country. Even the export also is part of it, so you can still say it extend outside the country also, but it has to deal with goods and services, and anything like that is under current account. So at the end of the day, we can even say balance of trade is also under current account. Balance of trade is also under current account. So now, before you can run the current account, you have to check every credit and also every debit. So every debit, all the credit that you have now, you subtract the debit from the credit. More like you do the export and the import. So you subtract every import from the export. So to make it more simpler, I'll say you should say the credit, that is money received, you add everything together first. So if you are talking about that, you are picking the 52,000, which is the first one, plus the shipping, which is the 4,000, plus the 20,000, plus the 20,000, plus the 2,500, plus the 22,800. The unrequired transfer. But if we are talking about direct investment, that one is not there because it deals with assets, and we'll talk about that later. So addition of everything now all together will give you 52,000 plus 4,000 plus 20,000 plus 2,500 plus 22,800. So everything gives us 101,300. And the debit own will be the other side of them, which is the 4,000 plus 8,000 plus 5,000 plus 7,500 plus 7,000. Now give us 4,000 plus 8,000 plus 5,000 plus 7,500 plus 7,000, and that will give us 31,500. So the balance of current account, which is equals to the credit minus the debit, will now be equals to 101,300 minus 31,500. So minus 101. So you have it to be $69,800, and that's your balance of current account. So when we're talking about the balance of capital account, about the capital account it deals with change of assets, investment in land, anything that deals with assets, maybe land, maybe properties, maybe exchange of resources, and all those things. Anything that deals with exchange within the country, or anything like change of patents, so anything like that falls under capital. And in this question, they've even simplified it by mentioning the long-term capital and the short-term capital. Automatically, that will fall under capital. And direct investment also is under capital, because it's a direct investment. You invest it on an asset, so it falls under capital also. So which means that one also is more like the credit minus the debit, or the export minus the import, anyhow you want to call it. If you export a goods, you have a credit because you'll be paid. That means a money will be received. And if you import it, it means you have to pay out. And that's a debit if you pay out. So the same thing goes to it also, but what you are balancing there for its own credit now will be the direct investment, which is the 50,000 plus the long time, which is the 254,000 plus the 221,000, and your answer will be 50,000 plus the 254,123 plus the 221,000, and you have that to be 525,000. And the debit now, the debit will be the other side, which is 26,000 plus 289,000 plus 238,000, and that will give you the 26,000 plus the 289,000 plus the 238,000, and that is 553,000. So your balance of capital, account is equals to 525,000 minus 553,000. So 550 minus 553,000, and your answer is minus 28,000. And since this one is negative now, you call it balance of capital account deficit. Call it deficit. And this one that is positive here, which is the balance of current account, is called balance of current account surplus. This one is surplus, this one is deficit, because the surplus means at the end of the day there is still profit on the ground. That is, the money you gain from your export is larger than the one you have with your import. So now the third one now, which is the balance of payment. Balance of payment is equals to your current account, that is balance of current account plus your capital account, and from this here you can see that your current account, where is our current account, is this our current account, yes, which is 69,800 plus minus, our capital account is minus, so, and this is the plus there, so plus minus 28,000, which is our capital account, and you have it to be 69,800 minus 28,000, and your balance of payment account is 69,800 minus 28,000 is 41,800 in dollars, and this also is in dollar. So at the end of the day you can say balance of payment surplus, and this is how you balance your payment. This is how you balance your payment, the payment of a country.